One of the most highly requested videos I've had is a full trade breakdown on the NASDAQ futures for the New York session. So this how to spot liquidity sweeps, right? How to identify trapped buyers and sellers and how to find exhausted plays in the market. And this using the bid and the ask. So with that being said, let's dive into it. So when I frame a trade, what I'm typically looking for is I want to see price sweep liquidity, and then we go on to look at fair value gap. So this is NQ on Friday the 6th of June, and we're going to be going over a trade recap. So we're going to begin by understanding it session by session, right? So what we have over here, this is the daily candle. So the daily candle is very important because the daily candle essentially tells us where price is relative to the daily opening price. And so the daily opening price is going to be around here. So for those who don't know, the Asian range, specifically if I go and change the settings to make it correct myself. So the Asian range is from 8 p.m. to midnight New York time, right? So let's get that right. So this is now the Asian range like this. So the Asian range itself is very important because it gives us an accumulation of the markets, right? So once that's being done, right, just going to change that now to the New York midnight opening price, which is going to be around here. Now, if we continue to play price on, right, I want traders to get into the habit of looking left. Looking left is very important because what we can see over here is we can see price giving us a large kind of fair value gap over here. We also see the markets giving us a fair value gap over here, right? The reason I like to look left is because I want to see essentially fair value gaps because the market itself gravitates towards two areas, right? Fair value gaps and liquidity. Very important to understand this. And so if we kind of just keep these over here to the left, what we're looking for in the New York session, right? Very important. When I come into a trade, the first thing I'm looking for is liquidity as well as the power of three. So these are the two concepts I use in a lot of detail. So to just kind of zoom out of price a little bit, let's take a look at things from kind of a higher time frame perspective. So if we go to the weekly, right, we understand how the weekly candle has been forming. We're coming into Friday and we're significantly above the weekly opening price, right? So we've seen price start here on Monday and we've of course expanded higher. Now on Friday, we're typically looking for that high of the week if it hasn't already occurred on Thursday, right? So quick tip about this. If you see a fair value gap from Thursday being respected, we can assume Thursday gave the high of the week, and therefore on Friday, because we're significantly above the weekly opening price, we should really be positioning ourselves for sells, right? That is how I use the weekly opening price to my advantage. And now when we go back to regular price action like this, right, if we just go back to the daily power of three. So on the daily power of three, we can see now we're significantly above this daily opening price and we're coming into these fair value gaps from the previous session. And so how am I trading the New York session? So what I'm looking for myself is I'm simply looking for three things to take a trade. The first thing I'm looking for is a key level, or in this case, a 15-minute fair value gap, right? I want to see a 15-minute fair value gap. When you're trading, you always want to be trading off a fair value gap, right? But what in itself will validate a fair value gap? Because you can't trade off every fair value gap, right? So a lot of people ask me, you know, would you trade this fair value gap, right? Would you see price kind of coming into this region and then heading higher? Well, the answer is no. I mean, I'm not going to trade this fair value gap, right? I don't like this fair value gap. Now, why don't I like this fair value gap? Well, there's a couple of reasons, right? And they're both interlinked. The first thing is we have our Asian range low, which is all the way down here. For those who've been trading right 2, 3, 4, 5 years, you will know that the Asian range is simply, I mean, it's the Asian lows and highs are what the market will target, right? Now, because we know that, what we need to then understand is that this particular POI or that particular 15-minute fair value gap wasn't my interest. And so the reason I'm saying that primarily was because of the fact that we're significantly above the daily opening price. So from here, when we go into the candles and we kind of dive into them in more detail, what we're looking for is typically a 3-bar swing pattern with a 15-minute fair value gap. And so this is the fair value gap I want traders to identify. So what's going on is we have this FVG over here, this line over here. So this line over here is going to be the start of the fair value gap, and this line is the end of the fair value gap. So the gap between the two lines that you can see over here represents that fair value gap. And now a fair value gap fundamentally is different to a point of interest. And now I get a lot of questions about how I determine my points of interest, and I want traders to understand this. So when I choose a point of interest, it's always the candle before the fair value gap, right? So the fair value gap is essentially this black candle over here. Now my POI is going to be the candle before. And so the reason for that is because when you are trading, let's say we go down to the 5-minute time frame, right? When you're trading this, you can even refine this fair value gap further to be the candle before the fair value gap. So I would refine it like this. So if when we go down to the 5-minute time frame, this is essentially the fair value gap. I'm going to label that in blue. And so why do I fundamentally put the POI different to the fair value gap? So this here, I'm going to label it. This is our point of interest. And so a point of interest, you can say it's a supply area, or vice versa, a demand area. So this here is a potential supply area. So why do I call it a supply area, and why is this a potential supply area, right? So this is going to be a potential supply area. And so the reason for that is because when price comes into this area, we want to see price come in, therefore filling the entire fair value gap, right? These are how those A plus setups are formed. So when you're forming an A plus setup, you want to see price tapping into the fair value gap before potentially giving you those sell trades, right? That's typically how I'm approaching the lower time frames. So now that we have this in place, right, a couple of things to notice about this POI or this fair value gap, right? We've noticed how we've taken out the London high, right? These are intricacies you want to understand. Now we've wicked above the London high, and then we've had a fair value gap. Now, because we're significantly above the daily opening price, again, you can see here the daily opening price is all the way down here. So we want to be selling when the market is overextended past the daily opening price. So these are how I form my high probability supply and demand zones, right? A question I get a lot. So what are you looking for when you're looking for that 15-minute fair value gap, right? So 15-minute fair value gap itself, you want to have some kind of a power of 3 alignment, right? Usually the daily. In this case, we have the weekly power of 3 and also the 10 a.m. power of 3. So if you look at the 10 a.m. Eastern candle, I believe we opened somewhere, not the best price really. I think we opened around here, right? So we're not significantly above the 10 a.m. Eastern, but we are significantly above this daily opening price, which is all the way down here. A large extended daily power of 3 candle gives us confirmation that we should be selling, or this is a potential supply area because we're above that daily opening price. So if there's one thing you want to take away from this video, if you can just sell above the daily opening price, or you have the discipline and the patience to wait for price to get above the daily opening price, this can significantly decrease the amount of losses you take, and therefore it allows you to save a lot more mental capital, and it gives you a lot more confidence to take those winning trades, right? Just a quick tip, right? Daily power of 3, super powerful tool, right? So you want to use a 15-minute fair value gap to trade from, right? Now, when price comes into this fair value gap, right? What else am I looking for to validate a fair value gap? Now, we've seen the London high get swept, right? So this London high over here, I'm going to label it in yellow. So we want to be trading as close as we can towards the daily high, right, or the candle's high. So we're trying to enter inside of this wick. So we want to have confirmations that give us the fact that this fair value gap is going to be a strong fair value gap, right? It's going to be a high probability fair value gap. So the way we do that just from candlesticks is we want to look at a liquidity sweep, and we want to look at the fact that we're significantly above the daily opening price. So we're using power of 3 and liquidity, all right? So from here now, if we just head down to if we just keep playing price on, right, we want to see price enter this area like this. So we're patiently waiting for price to enter. Right, now we've entered, right? Now we've had a solid entry into this area. So now the question becomes, what are you looking for inside of this region, right? How do you know price is going to react? Because previously, for those who were trading, some of these fair value gaps over here, right? We saw some choppy price action over here. So for example, if we tried trading a bearish fair value gap in this region, for example, I see a lot of traders making this mistake, right? Classic mistake. They'll take a fair value gap out of session like this, and they'll wonder why they get stopped out, right? So taking just random shorts or fair value gaps like this is just not going to work, right? It's just not going to work, right? So a lot of traders, they either take the wrong fair value gaps or they miss the right fair value gaps. And so there's no real way to get around this other than using the order flow, right? I don't see any other way around this. When you trade using the order flow, you can kind of catch the scalp trade with more accuracy. And so this is the same chart, right, as the one you see over here. It's the same exact chart. Instead, now we're on the ATAS platform. And so the ATAS platform is what I use, a lot. I use the ATAS platform a lot when it comes to trading and making entries. And so I want to do the usual where I want to break this chart down, right? So just a couple of things to kind of break away. So let's also have the two charts next to each other side by side, right? I think this is going to be very powerful for traders. So we have the right hand side, which is going to be the candlestick charts, and we have the left hand side, which is the order flow. So I want traders to first focus on the initial fair value gap candle. So that's this M5 candle over here. What's super interesting about this is that when you look at the candle in more detail, what this candle represents is, we can see here, So what's interesting is that we can see this particular this bearish candle over here had a huge aggressive buyer stepping into this market, right? So the candle is red, but you can see a massive buyer. And the reason I can see that without even reading the numbers is that we see a delta outlier. We see a blue delta outlier. So what's interesting, when we go into this, we can see 22 for 213. So immediately, what does that tell you about the buyers in this case, right? So when you see 213 on the right hand side, right, that's the ask. The ask represents aggressive buying. So if you're trading the New York session, right, and you see these large red candles, right, fair value gap candles, when you see a buyer inside, I want you to stop and think, right, what does that mean? What does that tell you as a trader? So even from a common sense perspective, right, you will be able to look at that and you'll be able to say, right, we have a red candle, price has given us a bearish fair value gap, but we see a huge aggressive buyer stepping in the market, right? So you want to ask yourself, the market's moving down, but there's an aggressive buyer. So is this aggressive buyer actually being successful, right? So you wouldn't want to be a buyer inside of this candle, right? So when you go to the ATAS platform, it unlocks a different side of your trading, right? You can begin to validate your fair value gaps. You can validate your order blocks, right? This is an order block or a POI or a supply zone. You can begin to use the basics of order flow, delta, for example. This is what we call the delta. This is a delta outlier, right? So in this case, the delta very simply is going to be 213 minus 22, right? That's roughly 190 something, right? So you can see a significant blue delta, right? You can see significantly more aggressive buyers in this region. Now the question becomes, are these buyers being rewarded, right? And that's why we have POIs and fair value gaps in the first place. So you want to ask yourself, what was going on in this first tap, right? So this first tap that I've labeled in red represents this first tap over here. So where I've circled is where we're going to study. So what you can see over here, you can see a lot of blue delta, right? This is a delta outlier, this is a delta outlier, and this is a delta outlier. So we're seeing aggressive buyers entering the zone, right? So if these aggressive buyers were successful, they would have broken above this zone, right? They would have broken above the POI, and that would have invalidated your sells. You do not want to be selling inside of a bearish POI, right? That is not correct. And this is the reason so many people take losses. So you can see the first initial reaction. We saw buyers stepping into the market, but buyers were failing, right? So when you see buyers failing, aggressive buyers failing, this shows you that the sellers are really in control, right? We're seeing a rejection. So when you see a wick rejection like this, what it essentially tells you, right? What it tells you from a trading perspective is that the aggressive buyers are failing. Now, when we continue to play price on, right, let's just play price on from a candlestick perspective, right? We can see a second entry, right, before the trade kind of takes off to the downside. So the question now becomes, you want to be studying these two areas that I'm going to label, right? You want to study what's going on here, and you want to study what's going on over here. So let me just label this in light blue, right? So this is going to be in light blue, and this is going to be in light blue. So what's going on inside of these two boxes, right? So we've already studied the first box. Let's look at the second box, which is we're going to study in even more detail. And this is what's even more interesting. Now, we saw a green candle followed by two red candles. Now, you're not interested in the red candles, right? In the black candles. You're interested in what's going on over here, right? So when you see a wick rejection, right, you want to understand what's going on inside of a wick. And typically it is a shift of delta, and it's an absorption and exhaustion of buyers. So this is what I spoke about earlier on in the video. It is an exhaustion of buyers. And so what do I mean by that? Now, if we go over a few numbers, this is a delta outlier, 15 for 46. That's just over a 3-to-1 ratio. There's 3 times as many aggressive buyers as sellers. They're hitting the ask, and the ask represents aggressive buyers. Same over here, 14 for 29. That's just over a 1-to-2 ratio. And then what's even more interesting is that we see some zero prints, right? New York session zero prints are a classic when it comes to your trading. So we see 0, 0, 0, 0. So a 0 is what I am looking for. When you see a 0 at the top over here, right, this gives you a much higher, a significant chance of your trade to the downside working out. Because when you see a 0, this represents a finished auction. So what I mean by finished auction, right? Market is an auction between buyers and sellers, represented by the bid and the ask. And so if you see a 0 on one side, in this case, the bid is 0. So what you want to understand from a logical perspective is that there's no sellers left, right? There's no sellers over here. So if you see no sellers all the way at the top and you see 2 massive red candles, Well, that's showing you something is moving the market down, right? That's showing you that if buyers are present, right, these buyers are failing horribly, right? So even from a logical common sense perspective, right, if buyers are failing to break above the level, this gives you the indication that you should be selling, right? That sellers are in control of the level. And so what we call this over here is an exhaustion of buyers, exhaustion of aggressive buyers. When you see an exhaustion of buyers, it means buyers have effectively been fatigued, right? They've tried to break the level and they've failed. And we've seen that on 2 occasions. And so what I like to do as a trader is I like to look for an entry inside of a 15-minute fair value gap, right? So let's kind of break down the trade, the trade kind of thesis. I want to see a 15-minute fair value gap. I want to see price enter the level, right? Entry with PO3. So remember, we're significantly above the daily opening price. And I want to confirm everything with the order flow. And so that's what we've done over here. I'm just going to write OF. So the reason we saw this zone holding wasn't because of any ICT pattern. It was essentially the bid and the ask data. So we saw aggressive buyers failing here, aggressive buyers failing here. So when you see price breaking to the downside, right, you can take a short entry from this position because we've seen the aggressive buyers fail. And so when we go back to the regular candlestick chart, the way you could have taken this trade was essentially just off this area with a stop loss just above this box. And so where do you want to target? Well, good question. In a very choppy market like this, I would first target the recent low down here. So we're simply scalping, targeting the most recent data low. It's really that simple when you understand what you're looking for, right? So obviously the market moves down, we had a nice scalp. And so this is essentially the entry model I use for all my trades, right? I trade ES, but I understand NQ is just as popular. So just to sum up this video, I want traders to understand you want to trade off a 15-minute fair value gap, right? You want to use power of 3 to determine whether you should be buying or selling in terms of your positioning. And when price comes into an order block, I can't stress enough, right, the importance of the ATAS platform. The ATAS platform will give you an indication as to whether to buy and sell because you can see exactly who is in control between the buyers and the sellers.